Okay, here we go. This is Ken at Capital Advantage Tutoring, and we are doing a new thing. I'm going to try a new thing where I'm going to see how AI does against FINRA. So it's FINRA versus GPT, baby. The battle of the titans. Not really titans, it's just things. But I'm going to do this for GPT. I'll probably do Grok. I'll do Perplexity, and maybe I'll do a little. I'll do it against Achievable. See how they do. I've already gotten permission from Achievable to do this, so we're going to get this going. So let's get into this. So I'm going to read the question out loud into GPT instead of me typing it because I can't copy paste. Then I am going to, what are we going to do? We are going to have them answered. They will pick the answer. That will be their question. I will not worry about any of their questions. Okay, so I'm going to let's start with number one, baby. Here we go. FinCEN accomplishes its mission to safeguard the financial system from the abuses of financial crime, including terrorist financing and money laundering, by enforcing A, SEC regulations, B, the Bank Secrecy Act, C, the Securities Act of 1933, and D, the Investment Company Act of 1940. So let's see let's see if we got it right. A, yeah, they wrote it all right. So let's see how we do, baby. So it's going to come across. It should reformat it. And then it's going to go into this. If you guys have questions, throw them in the chat. So the answer is B as in boy, because they say FinCEN, the Financial Crimes Enforcement Network, is part of the U.S. Treasury Department. Its job is to combat money laundering, terrorist financing, and other financial crimes. The BSA is a primary law that requires firms to file currency transaction reports and SRs, both core tools for FinCEN enforcement. The others are securities law handled by SEC, not FINRA. So we're going to go with B as in boy, right? B. Let's make sure the speaker's off, right? Okay. Thought I was hearing myself. Okay. So now, here's another one. Question 2. A company announces a tender offer to its shareholders with the intent to buy a maximum of 1 million shares of its outstanding stock at $10 per share and sets no minimum number of shares to be purchased. An investor wants to participate in this offer and tenders his 1,000 share position. At the close of the offer period, only 900,000 shares have been tendered. How many, if any, of the investor's shares will the company purchase? A, 0, B, 100, C, 900, D, 1,000. So let's make sure they wrote it right. Let's see. I got to make sure it's a tender offer to buy a maximum of 1 million shares if it's outstanding stock at 10. It says no minimum number. The investor wants to participate in this offer and tenders. I guess you can understand me. A, B, 1. Okay, I love it. Let's see how they go. Let's see what they're going to say with. So their answer is D, 1,000. The reasoning, the company offered to buy up 1 million shares at $10 per share, but didn't set a minimum requirement. Since only 900,000 shares were tendered, that's below the maximum. So the company can buy all 900,000 tendered shares. Because there's no oversubscription or proration needed, every shareholder who tendered, including this investor, gets a full amount accepted. If it had been oversubscribed, say 1.5 million to 1 million, shares would be accepted pro rata, but here everyone gets taken. Now, what they mean by pro rata is if it was 1.5 million tendered and there's only 1 million shared, they would decide everyone would get, like, you would divide 1 by 1.5 million and everyone get like 60%. So if you put in 1,000 shares, you'd only get like 600 shares. But the answer is D as in David. Okay. Let's keep moving. Number 3. And we're going to find out how they did at the end. I'm not going to give yes or no. Which of the following statements is true about all U.S. government agency issues? A, they are exempt from federal taxes. B, they are exempt from registration under the Securities Act of 1933. C, they are issued in bearer form only. D, they are general obligations of the federal government. Looks like they wrote it all right. So let's see how he does. GPT, baby. Let's see. The answer is B. They are exempt from registration under the Act of 33. Reasoning: all U.S. government agencies, securities, whether directly backed Ginnie Mae or indirectly backed by Fannie and Freddie or Federal Farm Credit Bank, are exempt securities under the Act of 33. That means they don't have to file a registration statement with the SEC before being offered to the public. However, they are not all federally tax exempt. Most agency issues are subject to federal tax. Bearer form issues are long gone. They're book entry now. And only treasuries, not agencies, are full faith and credit obligations of the U.S. government. So the only universal true statement exempt from registration under the 33 Act. Okay. We are on a roll. Question number 4. Question number 4. Which of the following actions is required of a broker-dealer's anti-money laundering program? A, designated AML compliance officer. B, filing of the firm's AML program with FINRA. C, conducting background checks of all employees. D, identifying to regulators the employees responsible for currency transaction reports. I just have to make sure it's written correct way. Okay, it looks good. I guess I'm not mumble as much as I think I do. D, designated an AML. Answer is A. See, I read D. A, designated an AML compliance officer. FINRA Rule 3310, which implements BSA, requires every broker-dealer to establish a written AML program that includes policies and procedures to detect and report suspicious activity, designation of an AML compliance officer, ongoing employee training, independent testing. The firm must identify that AML officer to be FINRA, not file the whole program, but it doesn't have to submit the whole full manual. So the only required action from this list is appointing and designating an AML compliance officer. And if you hear questions that you think are wrong, throw it in the chat and we can discuss. So that's the next one. Number 5 we're on to. Blue sky laws are regulated by which of the following entities? A, SEC, B, MSRB, D, C, FINRA, and D, state securities regulators. Okay, it looks good. Sorry about that, guys. Their answer is D, state securities regulators. Reasoning: blue sky laws are state level securities laws designed to protect investors from fraud and abuse in securities offerings and sales. Each state enforces its own version of these laws through the state securities administrator or state securities regulator. The SEC handles federal securities regulation under the Act of 33 and 34. MSRB regulates muni securities dealers, not munis. And FINRA oversees broker dealers, but state regulators are the one enforcing the blue sky laws. So we're going to go with D, state securities regulators. Okay. Number 6, an associated person who is not a registered rep is permitted to engage in which of the following activities? A, accept an unsolicited customer order. B, provide account opening forms to a new customer. C, discuss the attributes of a particular investment product. D, pre-qualify prospective customers as to investment objectives.
In the law, not right. I compel you to like and subscribe this video.
Looks good. Yep, I think it looks good. I'm hoping. I'm an idiot, so sometimes I miss shit. I'm not a detail person. The associated person who is not registered. B, provide account opening forms to a new customer. Reasoning: an unregistered associated person, like a clerk or an assistant, cannot engage in securities related sales activities or make recommendations. That includes accepting orders, discussing investments, or soliciting clients in any way. They can, however, perform clerical and ministerial tasks such as providing paperwork like account forms, forwarding completed applications, setting up appointments for registered reps. So the only activity allowed here is handing out account opening forms. So we're going to go B as in boy. Okay, here we go. Number 7, which of the following investment risks is the greatest risk in a variable life insurance policy? A, credit risk. B, market risk. C, inflation risk. D, interest rate risk. And here we go. Answer B, market risk. Reasoning: in a variable life insurance policy, the cash value and death benefit above the minimum guaranteed amount depend on the performance of the separate account, which is invested in securities like mutual funds. That means the biggest threat is market risk, threat danger, threat level 2000. DEFCON 1: if the market declines, the policy's cash value and potentially the variable portion of the death benefit fail too. Credit risk would apply to the insurer's insolvency. Interest rate risk mainly affects bonds. Inflation risk erodes purchasing power, but isn't the primary driver of value fluctuations here. So the correct choice is market risk, because variable life, securities based, not fixed income. So we're going to go with market risk, B as in boy. Number 8, under Federal Reserve Reg T, a 90-day restriction is imposed when a customer opens and closes which of the following positions? A, the same stock on the same day in a margin account. B, the same stock in different accounts on the same day. C, the same stock in different accounts in the same household. D, the same stock in a cash account without paying for the stock in full. There it is. Same stock, different accounts. I think it's good. Let's go. If you guys see me make a mistake, let me know. The answer is D, same stock in a cash account without paying for the stock in full. Reasoning: the question is testing your knowledge of free riding, a violation under Reg T. If a customer buys and sells a security in a cash account before paying for the purchase in full with settled funds, that's free riding. When it happens, the Federal Reserve mandates a 90-day account restriction, meaning the customer must fully pay for all purchases in advance during that period. Choice A, B, and C involve margin or different accounts, which don't trigger the Reg T free ride rule. The only situation that fits is D, the cash account with paying in full. Now, understand, when they freeze your account, it doesn't mean you can't trade or use margin or any of that. It just means any trade you do or security you want to sell has to be in the account ahead of time. Now, if you have a margin account and you get accused of free riding, you can still put money in the account, right? You can still do trades as long as you deposit the 50%. They will not accept a trade unless the money's there. So they said D, we're going to go with D. Okay. Number 9, engine number 9. Which of the following security types provides investors with a stated maturity date, a floating interest rate, and an option to put the security back to a financial intermediary on a daily or weekly basis? A, equity put option. B, perpetual preferred stock. C, variable rate demand note. D, tax deferred annuity, variable annuity. Let me make sure that's right. So I don't want to give them bad words. See what happened during the stutter? Okay, looks good. Let's hit it. Number 9. Okay. The answer is C, variable rate demand note. Reasoning: well, there's a long one. A VRDN, also known as a variable demand obligation, is a long-term muni security with short-term features. Key traits: it has a stated long-term maturity. The interest rate resets usually daily or weekly based on the current rates, maybe SOFR. And it includes a put feature allowing the investor to redeem put back the security at par to a dealer or a bank on short notice. That makes it act like a money market instrument with liquidity, interest rate protection. The others don't fit: equity put option, short-term derivative, no maturity date or interest. Perpetual preferred stock, no maturity, fixed dividend. Tax deferred variable annuity, insurance product, no put feature or short reset date. So the answer is VRDN, which is C as in Charlie. Good. Okay. I think we're doing okay here. Number 10, under FINRA rules, which of the following activities by a registered rep requires written notification to her firm? A, volunteering at the youth soccer leagues coach. That is horrible. B, gambling results in winnings in excess of 10 grand. C, driving part-time for a transportation network company on weekends. D, selling non-proprietary investment company securities products through her firm. No, I have to make sure to not make comments when I'm reading to GPT because it's going to put it in there, right? Look, it says that is horrible. I realize that I can't do that. Try to keep it here, keep it clean. Okay. 10 grand. Yeah, that works. Did I say 10 grand versus 10,000? That's funny. It's thinking. Uh-oh, we might have challenged it. What do we got here? C, driving part-time for a transportation network company on weekends. FINRA Rule 3270 covers OBAs. A registrant must provide prior written notice to the firm before engaging in any compensated outside business, even if it's unrelated to security. So driving for Uber or Lyft, compensated outside of work, must notify the firm in writing. Volunteering is unpaid, so no notification. Gambling winnings aren't a business activity unless you're a professional poker player. Selling non-proprietary funds through the firm. That's her job, to sell shit through her firm. So that's not outside employment. The answer is C, as in Charlie. Good. Question number 11. A decline in the GDP must last for at least how many quarters to be considered a recession? A, 1 quarter. B, 2 quarters. C, 3 quarters. D, 4 quarters. Don't ask the previous administration because they say that isn't true. Just throwing it out there. I'm sure every president would do that. No recession on my watch. The answer is B. A classic and testable definition of a recession is 2 consecutive quarters of declining real GDP. While the NBER officially declares recessions based on broader data, like employment and income trends, they must have heard me talk about Biden. The SIE and Series 7 exams stick to the textbook rule, which is B, 2 quarters. 50 cents. No, 2 quarters. 50 cents. No, 2 quarters. And we're back. Not that you know I was gone. I just had to answer a bunch of text because running a business is a pain in the ass. I love it, but it's a pain in the ass. It's a good pain in the ass. Okay. Number 12, these long questions. Why couldn't they give me 1 centers? Okay, here we go. Number 12, in which of the following situations is an employee of a public company permitted to trade upon information without violating insider trading laws? A, an independent securities analyst explains to the employees while the earnings for the company next quarter could be markedly poorer than expected. B, the employee's neighbor works for the government and informs him that the government will award a major contract to the company next month. C, the employee's spouse works in the corporate headquarters and shares with him a conversation overheard at work regarding possible acquisition targets. D, a coworker informs the employee of a conversation he had with the administrative assistant to the company's general counsel regarding key developments in an ongoing class action lawsuit. I got to read this to double check it's right. Okay, hold on. Good. Good. I like it. Okay, here we go. What are they going to say? The answer is A. An independent securities analyst explains to the employees why the earnings for the company next quarter could be markedly poorer than expected. Insider trading violations involve material non-public information that's obtained or shared in breach of duty or trust or confidentiality. In A, the analyst's opinion is publicly available analysis or speculation, not non-public inside info. So trading on that is legal. B, C, and D all involve non-public material information obtained improperly from a neighbor, a spouse, or an assistant to legal counsel. So the only lawful scenario is A. Anyone who gets that wrong is going to jail. So the answer is A. Don't go to jail, people. I lose viewers if you go to jail. Number 13, under normal circumstances, a customer's letter of intent on a mutual fund purchase is valid for what maximum period of time? A, 3 months, B, 6 months, C, 13 months, D, 24 months. Here we go. A little quiet time. Quiet time. Okay. The answer is C, as in Charlie, 13 months. Reasoning. A letter of intent allows a mutual fund investor to qualify for a breakpoint discount immediately based on the stated intention, they mean to, invest enough over time to reach the next sales charge. By rule, under the Vested Company Act of 40, the LOI is valid for a maximum of 13 months. So purchases made within that 13-month window counter the total. The fund will hold shares in escrow to cover the higher sales charge if the investor doesn't meet the goal. So the answer is, it's funny. They're even saying they're saying they're correct. How cocky are they? But they're right. Here we go. Number 14. Number 14, stability in the value of a debt portfolio is greatest when A, interest rates are rising, B, interest rates are falling, C, maturities of the debt securities are long, D, maturities of the debt securities are short. Let's make sure it works. Good. I like it. Here we go. And it's running. D, maturities are short. Remember, long and low, baby. Long and low. Long-term bonds move the most and low coupons move the most. So it means short ones don't move at all. But let's hear their reasoning. Bond prices move inversely to the interest rates, and long-term bonds swing the most when rates change. That's called interest rate risk or duration risk. Short-term maturities are far less sensitive to rate changes, so their prices remain more stable. Whether rates are rising or falling doesn't determine stability, it determines direction. Long maturities have more volatility, long and low, not less. Correct answer is D. Love it. Okay. Number 15. We are so far away from being done. Which of the following considerations should a registered rep explain to a customer when recommending a 529 savings plan? A, the potential deductibility of contributions from state taxes. B, the potential deductibility of contributions from federal taxes. C, the income eligibility restriction to contribute to the account. D, the rights of the account beneficiary to the assets at the age of majority. That's funny. It records everything. I'll take that out. Doesn't need to have that in there. Okay. My own little comments on this do not help at all. Okay. We're good to go. Let her run, baby. I need a second person here reading because this, okay. Right. So the answer is A. Contributions to the 529 savings plan are made with after-tax dollars. So they're not deductible at the federal level. And it's B. Some states, however, allow state income tax deductions or credits for contributions, which is an important to point to a registered rep must explain. Choice A. There are no income limits on who can contribute. C is wrong. And the account owner, not the beneficiary, controls the assets even if the beneficiary reaches adulthood. D is wrong. A is right. Good. Okay. Good stuff. Sorry, I had to run payroll before 8 p.m. Okay. Back. Number 16. Not that you guys give me shit. A member of a stock exchange responsible for providing liquidity in a security. I hope if I actually put the recording thing on, you get to hear it twice. A member of a stock exchange for number 16 is responsible for providing liquidity in a security by being willing to buy and sell at all times is known as A, a broker, B, an underwriter, C, a market maker, D, a transfer agent. Oy, okay. Change that around. Okay, let her rip. Let's see if they get it right. It is a market maker. Reasoning: a market maker stands ready to buy and sell securities from their own inventory on a continuous basis, quoting both bid and ask prices. This activity provides liquidity to the marketplace by ensuring there's always someone willing to trade. A broker merely matches buyers and sellers. An underwriter distributes new issue to the primary market. A transfer agent keeps track of shareholders and handles record keeping for issuers. Correct. C, market maker. It says it's correct. Liquidity providers. We're going to go with C as in Charlie. Number 17, UTMA, UTMA accounts are opened under the tax ID of the A minor, B donor, C parent, D custodian. UTMA accounts are under the of the minor. Answer is A. Under the UTMA, the account is legally the property of the minor, even though the custodian manages it until child reaches age of majority. It's in the minor's name, under the minor's social security ID number, and any income is taxable to the minor. And remember that, not the custodian or donor. And remember, it's one custodian, one child. They didn't say that. I did. Just add some shit in there because I'm getting bored. Okay, A. Number 18, a broker-dealer is permitted to accept payment for a new issue from a new customer when the A, registration is effective, B, red herring is delivered, C, preliminary prospectus is amended, D, transaction takes place during the cooling off period. And it looks good. Good. A, registration is effective. Reasoning that during the cooling off period, the time between filing and effective date, broker dealers can distribute the preliminary prospectus, the red herring, and take indications of interest, but they cannot accept orders or payments. Only after the SEC declares a registration effective, not approved, can the firm accept orders, accept payment, deliver the prospectus. A as in apple. Good. Here we go. Number 19, almost a third there. A transaction in which a writer covers a position by purchasing an option is called A, a closing sale, B, a closing purchase, C, an opening sale, D, an opening purchase. There we go. B, a closing purchase. Reasoning. When you write sell an option initially, you've opened a short position. That's an opening sale. To cover that position, you must buy back the same option, which is a closing purchase. Quick breakdown: opening purchase to buy open new long, opening sale, sell to open a new short, closing purchase to buy to close an existing short, closing sale to close an existing long. The answer is B, closing purchase. I think GPT is doing okay here. Number 20, the owner of which of the following products is most exposed to inflationary risk? A, utility stocks, B, treasury bills, C, treasury bonds, D, blue chip industrials. Looks good. Let's let her rip. C, answer is C, treasury bonds. Reasoning: inflation, purchase of our risk hurts fixed income investments the most, especially those with long-term maturities and fixed interest payments. T-bonds are long, 10 to 30, so the fixed payments lose value as inflation rises, high inflation risk. T-bills are short-term, minimal inflation. Utility and blue chip stocks are stocks, so they fight inflation. Boom. Okay. So the answer is C, as in Charlie, greatest inflationary risk. Number 21, the computation of dollar prices and accrued interest on muni bonds is normally on what calendar basis? A, 30-day month, 360-day year. B, 30-day month, 365-day year. C, actual days, 360. D, actual days, 365. I should start giving some bad answers, bad questions, or it starts getting shit wrong. I'm going to be pissed if it gets it all right. You just kind of fuck around with the wording a little bit, mumble a little bit. The answer is A, a 30-day month, 360-day year. So munis and corporates are calculated on a 30-day month, 360-day basis, meaning each month is treated as 30 days and the year is 360. U.S. Treasuries use actual days in a month, actual days in a year. The answer is A. So I always say corporates and munis are 3360. Corporates and munis are 3360. A boom. Number 22, the double twos, big double two. Great. I did that again. The primary purpose of a syndicate desk in the context of an equity offering is to A, determine the list of selling shareholders. B, build an order block and allocate the stock. C, solicit interest from investors in the stock offering. D, chaperone company management during the roadshow. I will have to change some of this because I said a couple wrong words. I'm going to leave that up, order book, not order block. I heard myself screw it up, but you can't change in the middle. Okay, let's see. It looks pretty good. 20. Double two, it did right what I wrote. Okay. B, build an order book and allocate the stock. Reasoning: in an equity underwriting, the syndicate desk is responsible for building the order book, collecting and organizing investor indications of interest, pricing the deal, and allocating shares among investors once the offering is finalized. Other roles: C, soliciting interest, handled by the sales force. D, chaperoning management, handled by the investment bankers. A, list of all selling shareholders, determining coordination with company counsel and the issuer, not the syndicate desk. So B, the syndicate builds a book and allocates a stock. Here we go. 23. The call provision of a bond stipulates which of the following factors? A, maturity date. B, call date and call price. C, original issue discount. D, coupon rate and call date. Let's see if it's written right. If I mumbled too much, get the number right. That's good. Answer is B, call date and call price. Reasoning. A call provision gives the issuer the right to redeem the bond early before its stated maturity. That provision spells out when the issuer can call the bond, call date, at what price the bond can be called, call price, and usually a par or a premium. The maturity date and coupon date are part of the bond's standard terms, not its call feature. And the OID relates to pricing, not redemption rights. So the answer is B as in boy. I really have to start sabotaging this thing a little bit. At issue, which of the following debt securities mature in 1 year or less? A, Fannie Mae bonds. B, Ginnie Mae bonds. C, Treasury notes. D, money market instruments. Here we go. It looks good. What is the answer going to be? Drum roll, please. D, money market instruments, obviously. Okay. Money market instruments are short-term debt issued with maturities of 1 year or less. They include, let's get this list out, T-bills, commercial paper. I was reading bankers' acceptances, CDs, and repurchase agreements. The others are long-term. Fannie Mae and Ginnie Mae are like multi-year mortgage-backed securities, and Treasury notes have maturities between 2 and 10. Remember, I'm going to give my own bullshit to it, but GPT has to get this all right themselves, and they're kind of doing okay. I don't want to admit it, but they're doing okay. Number 25 is a long one. Which of the following comparisons best describes the essential difference between primary distribution and a secondary distribution? A, primary distribution can only be made for equity issues, while a secondary distribution can be made for both equity and debt. B, a primary distribution can only be made for issues that exceed a specified dollar amount, while a secondary distribution can be made for issues of all sizes. C, a primary distribution must be made at a fixed offering price, while a secondary must be made at the current market price. D, a primary distribution involves a sale of newly issued shares by the issuer, while a secondary distribution involves the sale of already issued and outstanding shares. That is a doozy. I'm going to trust that it's right because I'm too fucking lazy to read it. We are now a third of the way in. It's thinking. Uh-oh. It's struggling. I was only kidding. I'm not going to sabotage you. Don't worry. I'm going to let you go. Okay. It's really thinking about this one. It's reading it. It's capsulating. Should I ask what's going on? Okay. I'm going to ask a question mark. Sometimes you got to throw a little question mark at it to give it. It's having a tough time. I'll have to give it an F for this one. I think it knows it. I think there's a glitch. Hold on. Let me try it again. Let me make sure it's right. Primary district can be okay. Let's see. I'm going to recopy it and re-answer it. Let me maybe even neaten it up a little bit. Oh, there it is. Okay. So what they say, we're going to have another chance. Watch as my internet's out. Let me see if it showed up on the other one, maybe. It's not reading it. Let me start over. Maybe. Oh, here it is. Oh, finally. Got it. The answer is D. A primary distribution involves a sale of newly issued shares by the issuer, while the secondary distribution involves sales of already issued and outstanding shares. Reasoning: in a primary offering, the issuer sells new shares to raise new capital. In a secondary, existing shareholders are selling shares they already own. Proceeds go to the shareholders, not the company. The other options confuse rule and mechanics that are untied to the key difference. Boom. The answer is D. Okay. I thought I had him. We thought we had him. think we had them on the ropes. $26. DPPs, direct participation programs, provide A, liquidity and transparency, B, exposure to non-correlated assets, C, market-related correlations with higher average returns, and D, investors with direct purchases of stock from public companies. Now, I'm wondering if I have to start a new chat here because I don't know if it's getting too long or not. Maybe that could be part of it. Who knows? Let's find out. Let's see if this one answers quick. We're going to be good. Oh, here we go. That was quick. So the answer is B, exposure to non-correlated assets. DPPs, like limited partnerships like real estate, oil and gas, and equipment leasing, allow investors to participate directly in the profits and losses of a business venture without buying stock. They're known for pass-through income and losses, tax advantages, and exposure to non-correlated alternative assets. They're not liquid, they're not transparent, and they're not connected to direct stock purchase. So the answer is B, non-correlated. I love it. I don't love it. They're doing well. Number 27, in a period of low inflation and economic recession, the Federal Reserve is expected to take which of the following actions? A, decrease taxes, B, raise the federal funds rate, C, buy bonds in the open market, D, require banks to increase reserves. Okay, here we go. The answer is C, buy bonds in the open market. Reasoning, during a recession, the Fed wants to stimulate, encourage borrowing and spending and investments. The main tool, open market ops. When the Fed buys treasuries, it injects money into the banking system. This lowers rates, increases the money supply, makes credit cheaper, all to boost economic activity. A, decreases taxes is fiscal, not Fed. B, raises Fed funds and increase reserves would tighten credit, the opposite of what's needed. So C is the answer. Boom. Buy bonds in the open market. Number 28. When is interest on treasury notes paid? A, quarterly, B, semi-annually, C, annually, D, at maturity. Here we go. See, what's good is once you get to the third, you feel better, but you're getting close to half. Okay. The answer is B, semi-annually, right? Treasury notes of 2 to 10 years and treasury bonds of 10 to 30 both pay interest twice a year, are semi-annual. T-bills are the only treasuries that do not pay interest periodically. They are discounted instruments that pay at par. Treasury notes, on the other hand, have a stated coupon rate and make 2 interest payments per year. B as in boy, semi-annually. Wonderful. 29. Which of the following statements is true about treasury stock? A, it has voting rights. B, it receives dividends. C, it is issued stock that has been subsequently required by a corporation. D, it is authorized stock that has not been issued and is held in the corporate's treasury. It's okay. Let's rip it. Number 29. C, it is issued stock. Remember, treasury is issued stock. It is issued stock, but it's subsequently, oh my God, I can't speak. Subsequently required. I'm having a tough time. Maybe I'm having a stroke. God, I hope not. It is issued stock that has been subsequently reacquired by corporation. Reasoning, treasury stock represents shares that were once outstanding but have been repurchased by the issuing corporation. Key facts, treasury shares are issued but no longer outstanding. They have no voting rights and do not receive dividends while held in treasury. Authorized but unissued stock has never been sold. That's a different from treasury stock. And the answer is issued stock. So always remember, treasury stock has been issued, just bought back. Number 30. Which of the following communications with the public is considered misleading? A, historical illustrations based on factual performance. B, product comparisons that illustrate material differences. C, a research report that includes a buy recommendation for a specific security. D, literature providing a 10-year performance information to support predictions of future performance. La, 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 la. Okay, here we go. So D is the answer. Reasoning. FINRA's communication with the public rules prohibit any false, exaggerated, unwarranted, or misleading statements or claims. Showing past performance is fine if it's factual and doesn't imply it will continue. Product comparisons are acceptable if differences are presented fairly. Research reports can recommend securities if they're properly supported, but using past performance to predict, you can't do, or guarantee future results is misleading and prohibited. Prohibidada. Past performance may not indicate future results. The answer is D. Okay. I'm getting a little nervous here. I'm going to be out of a job soon. Question number 31. Which of the following actions is required when a firm receives cash in excess of 10 grand from one customer in one business day? A, file a CTR. B, file a SAR. C, issue a cash transfer receipt to the customer. D, place a 5-day hold on the customer's account for the funds received. I'll make sure I wrote them. I didn't use the words, but it fucking figured it out. That's great. I was trying to screw with it. The answer is A, file a CTR. Under the BSA, FinCEN must file a CTR for any cash transaction exceeding 10 grand, either in one transaction or multiple related ones within a single day. CTR must be filed within 15 days of the transaction. SAR is for suspected illegal or suspicious activity, not just large amounts. There's no such thing as a cash transfer receipt or mandatory holding period in this context. A as an apple. Okay. We're getting near half, baby. 32. In the over-the-counter market, the term spread 'em, baby. The term spread refers to the difference between A, bid and ask price, B, offered and ask price, C, indicated in firm prices, D, opening and closing prices. I'm like rooting against it now. I was rooting for it before. Now I'm sort of rooting against it. I got to change that. Change the spread 'em, baby, out. Here we go. A, bid and ask. Mother pus bucket. Bargain ice hole. In the OTC market, dealers quote two prices: the bid, the price they'll pay to buy the security, and the ask or the offer, the price they'll sell it for. The spread equals ask minus bid, and it represents a dealer's gross profit margin on the trade. Offered and asked are the same thing. Indicated in firm prices isn't standard terminology here, and opening and closing prices refer to exchange traded sessions, not over-the-counter quoting. So the answer is A. Number 33. Which of the following outcomes are possible for the writer of a covered call option? A, profited limited and loss limited. B, profit limited and loss unlimited. C, profit unlimited and loss limited. D, profit unlimited and loss unlimited. Okay, I muted myself. I hope I didn't mute myself for the other question. But again, number 33, which of the following outcomes are possible for the writer of a covered call option? I wrote this and I'm redoing it because it read it wrong. Profit limited and loss unlimited. That's true. B, profit limited and loss unlimited. That works. C, profit unlimited and loss limited. I got to change that. And D, profit unlimited and loss unlimited. Okay, so that works. Okay, let's hit it. A, profit limited and loss limited. Correct. A covered call means the investor owns the underlying stock and writes sell a call option against it. Okay. A covered call, okay, we're good. Profit is limited to the premium received plus the gain up to the strike price. If the stock soars above the stock strike, they miss out on additional upside, capping profit. Loss is limited because they own the stock. So the worst case is the stock goes to zero. It's big but finite. By contrast, an uncovered naked call has unlimited loss potential. Answer is A. Number 34. If a market maker posts a quote of $10 by 1010, 25 by 10, I have to write it in here. Which of the following actions is a market maker willing to take? A, sell 1,000 shares at 10 and buy 2,500 shares at $10.10. B, buy 2,500 shares at $10 and sell 1,000 shares at $10.10. C, sell 100 shares at $10 and buy 250 shares at $10.10. D, buy 250 shares at $10 and sell 100 shares at $10.10. I'm probably going to have to adjust the way this wrote because it doesn't come. I have to make sure. Okay. Holy crap. No, they're all very close. I'm going to try to put it the way I have it. Not $25. It's going to be 2,500. Okay. It's not dollars. It's do this right, make it work right. 10 by 10, 10. Which if it was more. Sell 1,000 shares at 10, buy 2,500 at 10, 10. Buy 2,500 at 10, sell 1,000. You guys can try to answer this while you're waiting. Sell 100 shares at 10. Oh, okay. That looks good for me. Okay, here we go. What is the answer going to be? Answer is B, 2,500 at 10 and sell 1,000 shares at 10, 10. Remember, if it's wrong, I'll tell you, but I'm giving you their reasoning, not my explanation. In the market maker's quote, the first number, $10, is the bid, the price you're willing to buy. The second number is the ask offer, the price they're willing to sell. The numbers in parentheses are the round lot sizes expressed in hundreds of shares. So 25 by 10 is 2,500 share bid and 1,000 share offer, meaning the market maker is bidding $10 for 2,500 and offering to sell 1,000 at 1010. So the answer is B as in boy. My livelihood for 25 years. Number 35. When a broker-dealer charges a commission on a securities transaction, it has acted as A, agent, B, principal, C, underwriter, D, market maker. That was a quick one. I like those. I like those short ones. Okay. Where are we? Oh, looks good. Here we go. A as in agento. When a broker-dealer acts as an agent, it is executing trade on behalf of a customer, either buying or selling through another party in the market, and charges a commission for that service. When acting as a principal, the firm is trading for its own account, and the compensation comes from a markup or markdown, not a commission. Underwriters distribute new issues in the primary market. Market makers trade from their own inventory, principal capacity. The answer is A as an Apple agent. Remember, ABC, baby, agent, broker, commission, PDM, principal dealer market company. You can even say PIDM, principal inventory dealer market. So we're going to go with agent A. I'm getting depressed. Number 36. When selling a fixed amount of a base currency to purchase a counter currency, which of the following factors is primarily used to determine how much of the counter currency the customer will receive? A, the spot exchange rate. B, the counter currency's inflation rate. C, the trade balance between the two countries. D, the credit rating of the counter currency's government. Here we go. Let's make sure it's right. Spot, counter currency, trade. Good. And we're off to the races. The answer is A, the spot exchange rate. In any foreign exchange transaction, the spot exchange rate determines how much of one currency you receive for another in real time, usually for settlement within 1 to 2 days. They wrote 2. I said 1 or 2. The base currency is the first one quoted. So USD versus USR means $1.10 means 1 USD for $1.10 in euro. So if you're selling a fixed amount of base currency, the spot rate tells you exactly how much of the counter currency you receive. The other factors, inflation rate, trade balance, and government credit rating, may influence exchange rates over time, but they don't determine the conversion amount in the immediate trade. So the answer is A as an apple. I think we're at halfway. It's taking forever. Not sure they got one wrong yet. Number 37, a registered rep who wants to place a mutual fund advertisement must obtain written approval from which of the following parties? A, FINRA. B, each state securities administrator. C, a registered principal of the RR's firm, and D, the investment management division of the appropriate regional SEC office. Make sure it's right. Once you place a mutual fund, must read FINRA, States Administrator. Okay, I like it. We're good to go. I'm reading. I know I'm mumbling. You don't need to hear me reread it. So the answer is C as in Charlie under FINRA Rule 2210. Not that we care. All ads and sales, literature including mutual fund ads, must be approved in writing by a registered rep principal prior to first use. FINRA and SEC may require filing, but approval comes internally from the firm's principal. State administrators have no direct role in approving advertising. The answer is C. Remember, regulators don't approve. No regulator approves anything ever. So the answer is, what is a C, registered principal. Okay. I think we're now officially past halfway. Whoosh. Number 38. Upon expiration, all in-the-money S&P 100 index call options are settled by the delivery of which of the following? A, cash. B, S&P 100 index stocks. C, S&P exchange-traded funds. D, the same number of S&P 100 index options. Okay, I like it. It looks clean. It's a clean CR. A, cash. Index options like S&P 100 OEX or S&P 500 XBX are cash settled contracts. Because these options are based on theoretical index value, there's no actual basket of stocks to deliver. There's nothing to deliver. You get the in-the-money amount. If the option is in the money, it settles for the difference between the index value and the strike price multiplied by 100. If it's out of the money, it expires worthless. Answer A as in Apple. Index options are settled in cash. Okay. Number 39, a registered rep wants to participate in a private securities transaction. Which of the following actions must the RR take? A, request a meeting with his supervisor to lay out the structure of the deal. B, call a supervisor and inform her of the deal and the RR's potential involvement. C, send written notice to a supervisor outlining the activity and compensation structure. D, initiate the paperwork required by the policies of the firm once the activity has begun. I'm going to read this crap again. Measure up. Okay, request a meeting with the supervisor. Deal. Okay, we're good to go. It does a good job of reading my mumbling. C, send written notes to supervisor outlining activity and compensation structure. A private security transaction occurs when an RR participates in a security transaction outside the normal course of the firm's business, often called selling away. The rule requires 1, written notice to the firm before participating, describing the activity and potential compensation. 2, obtain written approval from the firm if compensation is involved. A meeting or phone call isn't enough. It must be in writing. Starting the activity is a violation. C. And then get approval. We're moving. Cooking with gas, baby. Under the Securities Act of 1933, registration is required for which of the following securities? A, Eurodollars. B, municipal securities. C, American depository receipts. D, securities issued by the federal government. Okay, I think we're clean. C is the answer. The Securities Act of 33 requires registration of new issues sold to the public unless they qualify for an exemption. Let's break it down. Eurodollars, U.S. dollars held outside the country, are exempt. Municipal securities are exempt from registration under the 33 Act. U.S. government securities exempt as well. ADRs represent ownership in foreign securities sold in the U.S. must be registered under the Act of 33. The answer is C as in Charlie. 41. Under a system of statutory voting, a common stockholder has as many votes for each vacancy on the board of directors as the number of A, positions vacant on the board, B, directors present at the meeting, C, shares owned by the stockholder, D, proxies available for voting by the board. Let's see if it read me right. Position vacant, directors present. Okay, I love it. Here we go. 41, the answer is C, shares owned by the stockholder. Under statutory voting, each share equals 1 vote per board seat. So if a shareholder owns 100 shares, and there are 3 board seats up for election, the shareholder gets 1 vote per board seat for a total of 300 votes. But these votes must be split equally among the 3 candidates. Can't pile them all on one. Contrast it with cumulative voting, where all votes, 300 in this case, can be given to a single candidate, giving minority shareholders more influence. The answer is C. A firm is a participant in a public offering to sell a substantial amount of the securities to its customers. The firm agrees to pre-purchase shares at no less than the original sales price. Such agreements are A, prohibited as fraudulent and manipulative. I have to write. B, permissible if the securities are deposited into escrow. C, prohibited unless the firm immediately sets aside funds for the repurchase. D, permissible if a customer retains a right to sell the securities in the open market. I did add my own little shit in there because I read this stuff and want to answer. Okay. Look at that. It actually took out my mumbling. Okay. That's pretty funny. It knew that I was rambling. Okay. A, prohibited as fraudulent and manipulative. Reasoning. A firm participating in a public offering that promises to repurchase shares at or above the offering price is effectively guaranteeing the customer against loss, which is strictly verboten under FINRA and SEC rules. Such arrangements are considered fraudulent, manipulative, deceptive, and just outright nasty because they artificially support or stabilize the market for the new issue and misrepresent the investment to riskers. There's no exception for escrow, setting aside funds, or allowing open market sales. It's flatly illegal. You're going to jail. A as an apple. Number 43. At the time of issuance, which of the following securities normally has the longest period to expiration? A, rights. B, options. C, warrants. D, repurchase agreements. It's clean. See where we are. The answer is C, warrants. Here's the breakdown by typical lifespan. Rights, very short term, 30 to 45 days, allows existing shareholders to buy new shares at a discount. B, options, generally 9 months. Leaps can go longer, but these are exceptions. Warrants, long-term instruments, often lasting several years or even perpetual, issued with bonds or preferred stock to make the offering more attractive, like lipstick on a pig. Repurchase agreements, repos, extremely short term, often overnight, up to a few days. So the answer is C, warrants. I always want to jump on options when I read this, and then I jump to warrants. I get it. 44. 44. Under SEC Regulation SP, consumer privacy, which of the following information must a firm include in its customer privacy and opt-out notices? A, the address of the firm's website. B, the fee to opt out of the privacy program. C, the deadline by which to opt out from the privacy program. And D, the policy to protect the security of non-public information. The address, the fee to opt out, the deadline, and the policy. Okay, let's go with it. Let's go with it. It's clean. D, the policy to protect the security of non-public information. Reasoning. Reg SP requires broker-dealers and investment advisors to provide customers with clear notices describing how they collect, maintain, and protect non-public personal information. Each privacy notice must describe the firm's policy and practices for safeguarding customer information. B, explain what information may be shared with whom, and include an opt-out option if the firm shares info with non-affiliated third parties. There's no fee or specific deadline to opt out, and the website addresses aren't mandatory, so D is the answer. Love it. I don't love it. I'm mad. Maybe there's they usually suck at math. Maybe we got lucky here. Number 45. Under industry regulations, an initial purchase of $3,000 of common stock in a margin account requires a cash deposit of A, $750, B, $1,500, C, $2,000, D, $3,000. Let's see what it does. Mother. The answer is C, 2000. Under Reg T, the initial margin requirement for stock purchases, okay, is 50% of the purchase amount. But there is a catch. There's a minimum equity rule. If the purchase is less than $4,000, the customer must deposit at least $2,000 or the full purchase price if the total is under $2,000. In this case, 50% of $3,000 is $1,500. But since that's below the $2,000, The investor must deposit $2,000 in cash. Correct. C, the answer. Boom. Okay. Okay, number 46. Let me do it here. Is the microphone on? Number 46, Roth 401k and Roth IRA plans share which of the following features? A, contributions are made pre-tax. B, neither account has maximum contribution limits. C, neither account is subject to early distribution penalties. D, qualified distributions are excluded from federal tax. Okay, I like it. Let's go. Let's let her rip. We're under 30 to the end. Okay, the answer is D. Okay. Both Roth IRAs and Roth 401ks are funded with after-tax contributions, and the big benefit is that qualified withdrawals, meaning after 59 and a half and after a 5-year holding period, are completely tax-free at the federal level. Now the rest, A, false. They're after-tax, not pre-tax. B, false. Both have contribution limits set by the IRS. C, early withdrawals can be subject to taxes and penalties. The answer is D, as in David. Blah, 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 blah. 47, under Rule 144A, an issuer of restricted stock is permitted to sell which of the following investors? To which? A, financial institutions. B, accredited investors. C, QIBs, qualified institutional buyers. D, non-accredited investors who have previously purchased restricted stock. So, to which? Fix it a little bit. Okay, make sure it's clean. I mean, I don't want it to get them all right, but I don't want to be lying. Okay, here we go. Let's go. 47. Oh, okay. Oh, so I got to start it. Let me start over. I think it might have got too long. Okay, here we go. I think I'm going to have to jump to a new chat. It's getting long. So I'm going to start a new chat. Let me tell it what it's doing. Just so you know, we're splitting up the chat. We're going to do number 47 of the SIE Practice Exam, which I know we're doing. So you're going to do the same thing where after I put it into voice, you're going to format it with an A, B, C, D, and then you're going to give me the answer and your reasoning. Feel free to be funny. Just make sure it's ready. Okay. Okay, here we go. Here we go. Now, under Rule 144A, an issuer of restricted stock is permitted to sell which of the following investors? A, financial institutions. B, accredited investors. C, qualified institutional buyers, QIBs. D, non-accredited investors who have previously purchased restricted stock. It's funny, I did it again, but I don't put the two. See what happens when you don't read? Okay, to which? Question 47. Okay, answer is C, QIBs. Rule 144A is Wall Street's VIP backstage pass. It's not for your average accredited investor or I know a guy money manager. I'm to put a little style in here. It gets boring. It's for the big dogs, QIBs, like insurance companies, mutual funds, pension plans, and banks with at least 100 million in securities already under managers. It lets issuers move restricted stock without registering with SEC as long as they sell only to QIBs. So basically, it keeps the retail crowd out of the private club while letting the institutions trade among themselves. 144 is selling restricted stock after a holding period. 144A is selling restricted stock immediately to QIBs. Think of it like 144A, A for authorized big boys only. So we're going to go with C as in Charlie. I have a little fun with this, right? Okay. So I'm getting my ass kicked here. Number 48, regular way settlement on treasury bonds is A, same day, B, next business day, C, second business day, called the skip day, and D, fifth business day. Looks clean. And we're running, and we're running, and we're running. There we go, 48. Just typing it out. Answer B, next business day, T+1. Reasoning, treasuries move fast. They don't want to wait around for your broker to finish lunch. Regular way settlement for U.S. government securities like T-bills, notes, and bonds is T+1, meaning it settles the next business day after the trade day. By the way, I've talked to GPT so much that it's getting my attitude, hopefully. I tell it I want SAS. By contrast, corporate and muni bonds settle T+1, still the same thing. Remember, GPT still thinks everything's T+2 except for treasuries. So remember that. That's why you don't always trust this shit. Finally, they made a little mistake. Okay. But hold on, it's helpful, but let me tell it. But remember, GPT, everything is T+1. There is no, I tell it all the time, more T+2. And it'll say, well, yes, you're right, Ken. Exactly. Nice catch. That's the post-May 2024 update. Okay. Boom. Okay. So it's still the answer. The old skip day answer is toast. Remember, trade today, pay tomorrow. Everyone's on the same clock. There you go. Okay. So we're going to go with B. Love it. Number 49, call protection is most valuable to a bond owner when bond prices are generally A, rising, B, falling, C, stable, D, fluctuating. Looks clean. Question 49, call protection was when bond prices are generally rising. A, when interest rates fall, bond prices rise, and that's when issuers start getting cute. They want to call their old high coupon bonds and reissue new ones at a lower rate. If your bond has call protection, it's like saying, hey, not so fast, pal. You can't take my juicy coupon away yet. So when prices are rising, meaning rates are dropping, call protection is your best friend. It locks in your high yield while the issuer drools over cheaper financing. Street version, call protection matters most when the market's hot and the issuer is scheming, whatever. Okay. So understand something. This is a trick question because everyone reads it as prices dropping. It's not. It's when they talk about rates dropping, this is about prices, or prices are rising. Answer's A. Number 50. No load mutual funds may have lower expense ratios than load mutual funds for which of the following reasons? A, no load funds do not charge 12B1 fees. B, no load funds are not permitted to charge 12B1 fees greater than 25 basis points. C, sales charges for load mutual funds increase their annual expense ratio. D, fund management fees for no load funds are always lower than load funds. May have to amend one of the words because I stuttered. Okay. That works. It's all good. Clean, baby. It definitely clears out when I stutter. Must know me. Okay. B, no load funds are not permitted to charge 12B1 fees greater than 25 basis points. Here's the deal. No load doesn't mean free. It just means no sales charge. But the SEC rulebook says if a fund wants to call itself no load, its 12B1 fees, the marketing distribution fees, can exceed 0.25% per year. That cap keeps their expense ratios lower than that of a load fund, which can tack on 12B1 fees up to 1% and sometimes other marketing or service charges. Translation for exam, no load equals no sales charge plus 12B1 fee under 0.25. That is a horrible way to remember it, but whatever. So again, A, false no loads can have 12B1 fees, are just limited. C, sales charges are not part of the expense ratio. They're a one-timer. And D, management fees are very not automatically lower. I think of sales charges as a cover charge to a bar. Okay. So yeah, B is your clean regulation back answer. Okay, we're in the last 25. Number 51, a customer buys one ABC Gen 35 put for a premium of 3 and simultaneously buys 100 shares of ABC stock for 35 per share. The customer will break even when the stock is selling at what price per share at expiration? A, $3, B, $32, C, $35, D, $38. A lot of people get this one wrong because they don't read it right. They think they just look at the puts. Let me make sure it's right. 3, 32, 35. Okay, there we go. Let's see what they say. See if they get it right. You're about to hear some dog barking. B, 38. This combo, long stock and long put, is a protected put. Now remember, whenever I'm going to say this, when you have stock and an option, it's always stock plus or minus premium. So it's stock, since it's two buys, buy and buy, you're going to add. If it's a buy and a sell, you subtract. So think of it like if you bought the stock, then bought insurance on it, your total cost is $35 plus the put premium of 3, that equals 38. At expiration, you break even when the stock price, your total outlay is $38. Above 38, you profit. Below 38, you lose, but the put cushions the fall. Break even with stock plus premium, put premium. So yeah, you're safe up to 38. After that, it's happy hour. And at 38, love it. Okay. Number 52, to offer its shareholders a privilege to obtain its shares at a fixed price. Which of the following products does a corporation issue? A, puts, B, rights, C, futures, D, preferred stock. Okay, let's see. So fixed price, puts, rights, futures, preferred stock. Good. Okay, let's get into it. It's thinking. It's thinking. It's thinking. It's still thinking. Why is it still thinking? There we go. Sometimes it takes a while. Let me challenge it. B, the answer is right. Okay. Okay. When a company wants to hook up its existing shareholders with short-term discount on new shares, it issues rights, officially called preemptive rights. They let shareholders buy stock directly from the issuer, usually at a price below the market, before the general public can. It's like an early bird special for loyal owners. I was thinking of it like if you're in a fan club for like Taylor Swift or something like that, they'll let you buy tickets before everyone else. Rights, short-term, fixed price privilege for current shareholders. Warrants, long-term, usually attached to a bond or preferred, and it's issued out of the money. And puts and futures, totally different playgrounds, options and commodities. Rights equal right now, short-term deal to buy at a fixed price. We're going to go with rights B. Number 53. All of the following risks apply to both foreign and domestic debt instruments except A, political, B, exchange, C, repayment, D, interest rate. The answer is exchange rate. Here's the deal. Domestic bonds and foreign bonds both face interest rate risk and repayment risk. Even political risk can sneak into both. Think regulatory changes or government instability. But exchange rate risk, that's foreign bond problem only, foreign only, not just bond, but only foreign. If the bond's denominated in a foreign currency and the dollar strengthens, your interest and principal payments suddenly are worth less than the US dollar. Domestic bonds are already in your home currency, no forex drama. Foreign debt dances with the dollar. Domestic debt doesn't care, whatever. Now, this is what I'm realizing. The reason these tests are hard sometimes, because these questions aren't ridiculous. People have biases that you go into. So that's what GPT doesn't have a bias. It just answers the question. So a lot of times we read this and we put our own shit into the question. So that's where there's exchange, because we start putting our own stuff into the question. You don't want to do that. Okay. So if you keep clean and just go into each question with an open mind, grasshopper, then it'll work. Okay. Which of the following statements is true regarding the concept of an annuity contract? A, payouts of an investment in a non-qualified annuity are all income tax free. B, the kind of annuity selected partly determines the payment amount to the annuitant. C, in the case of a life annuity contract, the age and sex of the annuitant do not affect payment amounts. D, the amounts of the periodic payments to the annuitant are determined by the performance of the insurance company's investment returns. Make sure it's clean. Payouts income tax free. The kind of annuity is partly okay. The case of okay, I think we're good. Okay, the kind of annuity selected partly determines the payout amount to the annuitant. The reason this one's all about how the annuity is structured. When you pick your payout option, life only, joint life survivor, period certain, unit refund, that choice directly affects how much you get every month. Life only pays the most, no beneficiary. Joint or period certain pays less because someone else might still collect. Breaking down the wrong answers. Nope. A, nope. It's a non-qualified annuity. Only the earnings are taxable. Your principal comes back tax-free. C, age and sex absolutely matter. Older annuitant, shorter life expectancy, bigger checks. D, that only applies to variable annuities, and even then it's based on the separate account performance, not the insurance company's general investment returns. The answer is what they say it was B. Number 55, which of the following responses describes an advantage of an index fund? A, the protection of principal during bearish markets. B, high turnover to take advantage of market opportunities. C, higher management fees due to active management of the fund. D, lower management fees due to the passive management of the fund. Let's make sure one thing. Protection principle or measure high turnover. Yep, it looks good. The answer is D, lower management fees to passive management. Reasoning, index funds don't try to outsmart the market, they mirror it. No high price manager making trades all day, no wild guessing, just track the S&P 500 or whatever index you picked and chill. Because of the passive approach, the fund doesn't need any army of analysts or frequent trading, which lowers the expenses and management fees. Let's kill the wrong ones. A, nope, index funds go down with the market, no downside protection. B, high turnover, opposite. Index funds have low turnover. And C, higher management fees, that's only actively managed. Passive equals cheaper, active equals pricier. So the answer is D as in David, lower management fees. Good. Number 56, which of the following investments are generally traded according to their average life rather than their stated maturity dates? A, corporate bonds. B, government bonds. C, asset-backed securities. D, fixed capital securities. Okay, I think they look good. Here we go, in there. The answer is C, asset-backed securities. Here's the deal. Asset-backed securities like car loan or credit card, receivable pools, and mortgage-backed securities don't have one clean maturity date. Why, do you ask? Because people pay off loans early or default early, constantly changing the time of the cash flows. So instead of quoting maturity date like on a bond, traders talk about average life, the weighted average time until investors get their principal back. Corporate and government bonds have fixed maturities, so they have no early prepayment risk. They have call risk, but it's built in. Fixed capital securities isn't even a real thing. Toss that one out. There we go. So it's going to be asset-backed securities, C. Number 57, which of the following statements is true regarding a customer account held as tenants in common? A, the owners must equally share the assets. B, the ownership of the decedent's assets is covered by their will or state law. C, tenants in common is permitted for use only with two individuals. D, tenants in common is permitted for use only for married couples or family members. Equally share the ownership of the disease covered, tenants in common. Okay, I like it. We're clean. Number 57. We're getting near the end. Okay, B is an answer. The owners of a decedent's assets is covered with a will or state law. In a tenants in common account, each owner holds specific separate percentage of the account. It could be 50-50, 70-30, or whatever the hell they do. When one owner dies, their portion does not automatically pass to the other account holders like it will with a JTWROS. Instead, it goes to the estate governed by the will or state intestacies law. Which is, remember, intestate usually means people are dead. Okay, now let's trash the wrong ones. A, ownership doesn't have to be equal. C, it can be two or more owners. D, not limited to married couples only. That's tenants. That's benefits for the entirety. Okay. Anyway, so I think it. So we're going to go with B as in boy. 58. Some math here. Company ABC announces a 20% stock dividend for its common shareholders. If a customer holds 1,000 shares at $50, what is the new price and number of shares following the payment of the stock dividend? A, 800 shares at $62.50. B, 1,000 shares at $41.67. C, 1,200 shares at $41.67. D, 1,200 shares at $50. Let's see if it looks. It's still reading it, so I gotta wait. Reading. Sometimes it happens. I'll be cutting this out probably. Or not. I'll just make you listen to my rambling. So how are you guys doing? Oh, there we go. 20% stock dividend, 1,800 at 62.50, 1,000 at 41.67. Okay, that looks good. Let's do it. Let's see what they say. What are we going to say? So the answer is 1,200 at 46.7. Okay. A stock dividend doesn't make you richer. It just slices the same pie into more pieces. Here's the math. 20% stock dividend, 20% more shares. 1,000 times 1.2 is 1,200. Your total value stays the same. So the old value is 1,000 times 50, which is 50 grand. After dividend, you do 50 grand divided by 1,200, 41 by 6.7. Okay. Now, quick formula, new price equals old price divided by, who cares about that crap? Okay. You got now 1,200 shares worth 41.67, same total value, just more slices. Now, what I kind of do sometimes is if I can get the new shares, then sometimes they only have one where the price goes down. It has to be that one because it can't be the price staying the same. So we're going to go with 1,200 shares at 41.67. I think that's what they said. Good. Remember, whatever they pick, I'm going with. 59. Which of the following form you for reportable events results in a statutory disqualification? A, personal bankruptcy filing. B, a written customer complaint alleging misappropriation of assets. C, a felony theft charge. D, a felony conviction for driving under the influence charge. Okay. I think. Let's go. D, a felony conviction for driving under the influence. Everyone goes, wait, what? It's a DUI. But it doesn't matter. Felony is felony. FINRA doesn't play around with felony convictions. Any felony conviction within the past 10 years triggers a statutory disqualification, even if it's not related to securities or finance. Let's break them down. Bankruptcy, embarrassing, yes. Disqualifying, no. That must be reported. Written complaint must be reported, but not automatically disqualifying unless it leads to an actual finding. C, felony charge. Charge is not conviction, only a conviction or a guilty plea count. Nolo contendere, convicted, all that stuff. Adjudicated. A felony conviction, even for DUI, that's it. FINRA says any felony, statutory conviction, statutory DQ. Boom. D as in David. That's what they said. Right, good. Number 60. We're getting near the end. Of course, it's a long one. Number 60. A broker-dealer ABC seeks to underwrite mutual. Hold on, let me start over. Number 60. Broker-dealer ABC seeks to underwrite a municipal securities offering by a local town in which the mayor is currently seeking re-election. A municipal finance professional who resides in the town and works for ABC contributed $200 to the mayor's re-election campaign 13 months ago. If the employee wants to support the campaign further without impacting the municipal securities business of the firm, he is permitted to make an additional contribution of up to what amount? A, $50, B, $100, C, $150, D, $250. Let's see if it reads it right. Okay. Okay, it looks good. Let's see what they go with. See if they answer it. Okay. Under MSRB rule, a municipal finance professional can contribute up to $250 per election to a candidate they are eligible to vote for without triggering the 2-year ban. The MFP in this case lives in the town, so he can vote for the mayor, meaning he's covered by the $250 de minimis. He already gave $200, so he can safely throw in another $50, but the total limit per election is $250, so that's the correct answer, okay? They did not. I think this was wrong. He can make an additional. Let me make sure I wrote it. Yeah, they wrote it right. They got it wrong. Funny. So I'm going to put what they put in there. Total limit per election is 250. They're going to say that. I think it's 50. Even though they addressed it, they read it wrong. Fine. No one's perfect. Okay, good. Number 61. Under FINRA rules, non-cash compensation connected with the sale of variable contracts includes all the following except A, gifts, B, meals, C, lodging, D, commissions. Accept. Good. Number 61. Let's see what they go with. Got it right. Not D as in David. Non-cash compensation means exactly that. Anything of value that isn't money. So things like gifts, meals, lodging are all forms of non-cash compensation. This is, okay. Commissions are cash, so they're not part of the non-cash category. If it jingles, it's cash. If it sparkles, it's non-cash, whatever. Okay, so D is an answer because it's everything. You're saying what's not non-cash. Non-cash is ABC, cash is D. Okay, you caught it. The last transaction in XYZ 5.5's 2030 was at 102. This bond is selling at A par, B premium, C a discount, D asset value. It literally did it exactly the way it should have been. That's crazy that it read that. It's at a premium B because it's trading above par. Bond quotes are based on percentage of par. At 100 par, above 100 premium, below 100 a discount. So it's a premium, baby. Love it. B as in boy. I feel better now. An investor owns 100 shares of XYZ common stock at the current market price of $50 per share. If XYZ conducts a 1-for-2 reverse split, the investor's post-split stock position will be A, 50 shares at $25 a share, B, 50 shares at 100, C, 200 shares at 25, D, 200 at 100. Make sure the numbers are right before I can submit. 100 shares at 50. So A is 50 at 25, B is 50 at 100, C is 200 at 25, D is 200 at 100. Okay, I like it. Let's let her rip. We're down to the last 12. So it's 50 shares at 100, right? So reasoning is B. A reverse split reduces the number of shares, but increases the price per share so that the total value stays the same. 1-for-2 means you get 1 share for every 2. 100 shares divided by 2 equals 50 new shares to keep the total value equal because it was $5,000 before. 5,000 divided by 50 equals 100. So it's there it is. Reverse split for fewer shares, higher price. Same pie, fewer slices. So we're going to go with B as in boy. Love it. Okay. Number 64. In the event of a stock split, which of the following parties is required to maintain a record of the shareholders eligible to receive the additional shares? A, DTC, B, issuer, C, custodian, D, transfer agent. Okay, I like it. We're good to go. I've never enunciated so specific lately. Answer is D. The transfer agent is the official record keeper of a company's shareholder list. When a stock split or stock dividend happens, they're the ones who track who owns what, issues new shares, and make sure no one's double counted or skipped. Maybe they could be at the elections. The issuer authorizes a split, but the transfer agent executes it. They handle the logistics and record keeping. So the answer is D is transfer agent. Number 65. Which of the following actions violates FINRA rules regarding selling away? A, recommending it to a customer the services of another broker-dealer. B, sharing commissions with another registered rep in the same BD. C, advising customers about mutual funds as amounts just below the discount level. D, engaging in private securities transactions without written prior consent of the employee broker-dealer. Okay, sharing commissions. I like it. We're good. I think we're clean. We're down to the last 10. D is in David, engaging in PSTs, private securities transactions without written consent. Prior. Selling away is when a registered rep goes rogue, selling or participating in a securities transaction outside the firm's supervision, usually for personal benefit or another firm without written approval from the broker-dealer. That's a big-time FINRA violation. Breakdown of the others. A, totally fine, just a referral, not a sale. B, okay if both reps are at the same firm and the firm allows it. C, shady, but that's breakpoint sales, not selling away. If you sell it off the books, you're selling away your career. So we're going to go with D as in David. But the corny shit at then is them. I'm just reading what they say. The redemption 66. The redemption value of an open-end investment company's shares is based on the A, previous offering price, B, previous closing net value, C, NAV, computed after the order is received. D, offering price computed after the order is received. Maybe I got to read that whole thing again. Maybe I will, and I'll just double check it. The answer is C. Open-end investment companies, mutual funds, and mutual funds trade once per day at the price determined after the order is received. That's called forward pricing per the investment company Act of 40. Purchase orders are filled at the NAV, the next calculated offering price, NAV plus the sales charge, if any. Redemption orders are filled at the next calculated NAV, not yesterday's price, not less close. So when you sell your mutual fund shares, you get whatever the NAV is after the fund calculates it, usually at 4 p.m. Eastern. So if you place the order at 3:59, you get the 4 o'clock closing. If you place it at 4, you get tomorrow's 4 o'clock closing. So the answer is C, as in Charlie. Number 67. Which of the following products is adversely impacted if the issuer's credit rating is downgraded? A, mutual funds, B, UITs, C, ETFs, D, ETNs. I got lazy. Let's see. Yep. See if it ends. I got lazy in there. ETNs. The answer is D. Reasoning, don't worry. This one's a layup. ETNs are debt instruments, not ownerships of a basket of securities like ETFs or mutual funds. They're unsecured debt obligations backed by the credit of the issuing bank. Think JP Morgan, Barclays, Bank of America, shit like that. So if the issuer's credit rating drops, investors start sweating, the ETN value drops too, even if the underlying index tracks hasn't moved an inch. The others, mutual funds, UITs, and ETFs, own actual securities, not the issuer's promise. Their value depends on the market, not the issuer's credit. ETN is an IOU. Okay, so ETN. We're getting so close. Which of the following stakeholders has first claim priority in a Chapter 11 proceeding? A, equity holders, B, secured debt holders, C, unsecured debt holders, and D, preferred stockholders. Equity holders, secured, unsecured, preferred. Okay. Equity, secured, unsecured. Okay. Here we go. B, secured bond holders. Okay. When a company files Chapter 11 reorg, everyone lines up to get paid, and it's not a democracy. Secured are first in line because they got collateral backing their claims. Assets like buildings, equipment, or receivables. If the company goes belly up, they can seize or sell that collateral to cover it. It's really a trustee that does it, not them. Then comes after so you have secured debt holders, unsecured creditors, like bondholders and vendors, subordinated debt, preferred and common. They get to its left, usually not. Okay. In bankruptcy court, collateral is king. So we're going to go with B, secured debt. A customer has a cash balance in her account together with long positions in several securities. She has made no securities transactions in the account during the past 18 months. How often must the firm send her an account statement? A, monthly, B, quarterly, C, semi-annually, D, annually. If a customer, it's starting to, maybe I'm stuttering. If it's good for you guys that I have to elucidate. Okay. If a customer has there we go. Change it up, baby. Has a cash balance in her account. You have the loan positions and securities. Okay, that works. Boom. B, quarterly. 2231 says firms must send Account statements at least quarterly to every customer has a securities position, money balance, or activity in the account, even if no new trades have been made. If the customer had active trading, statements would go monthly, but with no new activity, I disagree with that. I have not seen a single thing saying there's monthly anything. So we're going to go with they're wrong on that. Okay. Trade or no trade, if there's cash or stock, send that every quarter, clock or not, whatever. So it's going to be quarterly. I'm not reading their answer on that one. Okay. Number 70, which of the following represents the effect of a stock split? A, the price per share of the common stock increases. B, the price per share of common stock decreases. C, each stockholder's proportionate ownership decreases. D, each stockholder's proportionate ownership increases. Okay. Okay, I like it. We're getting near the end, really near the end. Okay. So answer is B, obviously makes sense. The stock split increases the number of shares outstanding while reducing the price per share proportionally. So the total market value stays the same. So that's why C and D are out. For example, in a 2-for-1 split, every shareholder gets twice as many shares at half the price. You own 100 shares at 60, now it's 230, total value equals unchanged. A, wrong, price drops, not rises. B, correct. C and D, both wrong, ownership percentage stays the same. More shares, lower price. That's what I say all the time. It's more shares, worth less. So the answer is B as in boy. Okay. A married couple who earned income that exceeded $300,000 in each of the prior 2 years and is reasonably expects the same for the current yield is A, qualified investor, B, accredited investor, C, institutional investor, D, a qualified institutional buyer. Okay, so the answer is B, accredited investor. Under Reg D of the Act of 33, an accredited investor can be an individual with income over 200 grand or miserable person, married couple, with joint income over 300 grand for each of the last 2 years and expected to be the same for the current year, or net worth over $1 million. I would say 1, 2, 3 accredited, 1 million net worth, or 200 salary single, or 300 married. Also, if you have, I'll add in, they didn't do it. If you have the Series 7 or the 65 or the 82 and it's in good standing, you're also accredited. The answer is B. A is qualified investor is not a defined Reg T term. C, institutional, that's for firms, not couples. And QUIB, that's the 144A stuff. So it's got to be accredited investor. Very good. Here we go. Number 72, what is the cost basis of an inherited mutual fund? A, the net asset value of the shares when the owner dies. B, the net asset value 30 days after the owner's death. C, the same cost basis as the deceased. D, the same cost basis as the deceased plus capital gains distribution. Okay, they have the answer is A. Reasoning, when you inherit an asset, stocks, mutual funds, real estate, the IRS gives you what's called a step up in cost basis. Although remember, annuities don't do that. They no step up. That means your cost basis resets to the fair market value at the date of death of the original owner, not what they originally paid for. So if grandma bought the fund at $10 and it's worth 25 when she passes, your new basis is 25. Boom, I love it. So the answer is, what do they say? A. Boom. Okay, we got a few more. Of course, it's Number 73, a customer is an officer of a company that is involved in some significant changes. All of the following items are examples of a corporate affairs that could be considered inside information if the customer shares them with his registered representative, except A, pending transactions, B, declared stock dividends, C, top management changes, D, imminent financial liquidity problems. Customer, all of the following are examples of corporate affairs that could be considered, except pending. Okay, good. We're good. It's clean. 2 more after this. B, declared stock dividends. The reasoning, here's the key: inside information material, non-public. stuff that could affect the stock prices and hasn't been made public yet. A, pending transactions, definitely inside information. C, top management changes, yep, material and off at market moving. D, imminent financial problems, for sure, that's huge and non-public. D, declared. Once a dividend is declared, it's public information. Before the dividend is declared, it's inside information. After, it's fair game. Okay, so the answer is B as in boy. Okay, two more. A savings account at a bank is guaranteed by which of the following entities? A, FDIC, B, SIPC, C, Federal Reserve, and D, Department of the Treasury. Okay, it looks clean. The answer is A, FDIC. Remember, banks are FDIC, broker-dealers are SIPC. Okay. Now, FDIC protects deposited on banks and saving institution if the bank fails, up to 250 per depositor per ownership category per bank. Let's clean up the rest. B, SIPC coverage brokerage accounts, securities and cash, not bank deposits. C, Federal Reserve regulates monetary policy and all the other stuff, doesn't insure deposits. D, the Treasury, they issue government debt, no direct insurance role. Okay, I love it. Bank fails, FDIC bails. Brokerage fails, a SIPC sales. Okay, so the answer is FDIC. Right, good. Okay. Last one. Of course, it's a doozy. A registered representative, maybe they'll get this wrong, is reviewing the following portfolio. It's not gonna. 30% ABC High Energy Company, 30% XYZ Healthcare Company, 30% ETFs tracking the S&P 500, and 10% money markets. Which of the following risks is inherent in this portfolio? Which does it have? A, credit, B, liquidity, C, political, D, non-systematic. Let's see if I get it right. See how it cleans up. Okay. It has, I'll do it that way. 30% high energy. No, 30% not high energy, 30% energy. That's funny. 30% healthcare, 30% ETFs tracking this, 10% money. Okay. Let's see what it says. Damn. D. Let's dissect this portfolio autopsy. The investor owns individual stocks, energy and healthcare, that introduces business industry specific risk, also called non-systematic. The ETF portion and the money market help diversify, but they don't completely eliminate company specific risk. Non-systematic risk is a risk tied to a specific company or sector, not the overall market. It can be reduced through diversification, but this portfolio is still pretty concentrated, 60% in just two companies. So the others, A, credit risk applies to bonds, not stocks or ETFs. B, liquidity, not really. All holdings are listed are liquid. C, political risk, that's more for international. Boom, love it. So we're going to go with non-systematic. Okay, so here we go. Click here to submit. 74, let me tell you, I'm going to tell you got 74 of 75 right. So it passed, right? 75 right. And we know why I got that one wrong. We did it before. Okay. 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 It goes, let me guess. I probably got chipped on until one technical interpretation question. Yeah. You missed the political. Let's see what it says. Political contribution. See if it remembers it. I'm assuming this. Let's see if it. So I told it. The only thing is that might have been on the other one. Okay. Okay, I overlorded it. De minimis is 250. Okay. There we go. So quick tighten up for the brain, right? The tested wanted the remaining allowable amount, not the total cap. So the key to enter is 250. Quick tighten up. Voter MFP 250 per election max. Already gave 200, only 50 left. Non-voter 0. It's per election. Okay. Boom. I love it. Okay. Let's make sure we got it. We'll go quickly through these. I know which one we got wrong, but we're going to make sure because I don't want to give the wrong answer. Be like, hey, you're wrong. Lots of green, baby. It did well. Should I give it an attaboy for doing well? Where is it? Well, it's pretty late. That was there. I hope I wasn't. Let's see. There it is. It's $50. Okay. I'm going to be nice to it. You did amazing. Any advice for test takers? Here's my no BS advice. Here we go. Ready? It's from the person who's got one wrong. Know the why, not just the what. Don't just memorize that a Treasury settles 2+1. Know why. Because the U.S. government dance faster clearing. When you know the logic, you can handle any curveball phrasing they throw at you. Focus on the always true rules. There's a lot here. Okay. FINRA loves absolute terms. Anything always or never should make you pause and think of the core rule. Okay. Learn to eliminate, not guess. You can kill 2 wrong answers instantly. You're already half there. This is all stuff we talk about. Is this about securities, taxes, or registration? Always ask yourself. That usually narrows it to the right lane. Pace like a trader. Don't linger. 85 to 100 questions, about a minute per. Mark anything you're unsure of and move. Okay. Unsure means 50%, not like I'm not totally sure. Okay. Expect curveball wording. Okay. FINRA rights and lawyers speak. An offering exempt from registration under section whatever. Subsequent sale to QIBs, stuff like that. Don't worry about it. The final 48 hours. I disagree with some of that. This is the big one. Everyone else is nervous. Be the one who looks like you've already passed. Breathe. Read every word, then hammer it home. I think we're in good shape. I love this stuff. I was very happy with this. Now we know that GPT can pass. Now remember, they do make mistakes. You saw that they got the T+1 right because it was T+1. But if it asked about T+2, it would have been wrong. Okay. So remember that. So keep that in mind. Okay. This is good. I will do for the other ones. I'm even going to do an achievable one and do it. GPT beats the achievable or doesn't beat it. Let's see what happens. But I think it did well. And then maybe we can have it take a series 7 one at some point and see how it does. Just fun stuff. And it's another way of taking the test and have a little fun. Everyone, thank you for joining. And I will see you guys every Tuesday night on my live Q&A at 8 p.m. Eastern on the Tube of You and Instagram and TikTok. Y'all have a good night.